Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
The lighting is better this week, and so it's finally everything running all right for us in this theatre. This is the last lecture of this semester. We're going to wrap up some so-called maybe loose ends of the whole asset allocation process or the considerations which are quite important for managing a portfolio. Here we're going to deal with a very brief discussion of industry ethics and also fund governance. These topics are not really relevant for an individual investor, but they are very important for institutional investors. That's probably a lot of finance students will work in this area. These topics, industry ethics, fund governance, and also the importance of rebalancing, they'll only be examined in the final exam on the conceptual level. So no numerical analysis or calculations will be involved, but the concepts are going to be quite important in terms of managing the portfolio towards its long-term strategic asset allocation. Lastly, the performance evaluation and incorporating investors' bias in the asset allocation. Each of these topics can be expanded into a standalone course. So our discussion will be very brief, and I tend to give you some general understanding in this area. And if you're interested to develop in this area, you probably will find materials or courses from CFA Institute about the performance evaluation and also for the investor bias. It's a school of economics, but not really the traditional or classic finance theories. So the behavioral finance, they are standalone. They want to separate them from the classic finance theories. We're going to talk about why they are not part of the traditional finance theories. For the last two topics, is for you to have some general understanding, and nothing specific will be examined in the final exam. The first topic we're going to discuss is the industry ethics. The reason that we have this in the course outline, partially because, as you know, we have the CFA's Awareness Scholarship. To have that scholarship and to be included in the CFA affiliation program, we have to incorporate part of the teachings from CFA materials into a few courses. So this course and corporate valuation, probably investments as well, we have to incorporate this. Another reason is that for asset allocation, obviously it's wealth for investment consulting, and also for funds management, the industry ethics, the code of conduct are part of your professional competency. In addition to the fancy model you are able to run and your exceptional expertise or insights in your area. So these are important part of the professional competence. So that's why they are discussed in a few of our finance courses. So our approach to industry ethics in this course is by giving you guidelines of several important standards so that you understand, okay, this is the professional requirement in the industry for the investment consultants, wealth managers, or generally funds managers. This first one, there's only selected standards. The first one we're going to mention is about duties to clients. So under these standards, you are supposed to provide appropriate advice to your clients. The appropriateness of the advice can be quite subjective judgment. If this particularly will be an issue if it are involved in a lawsuit. Or for example, last year with the Banking Royal Commission, they did investigate the behavior of financial planners affiliated with some of the largest banks in Australia. So when they decide if the advice is appropriate, they will have a look at the objectives, the circumstances of the clients, and have a look at if the advice itself is appropriate for this client's objectives and circumstances. So, for example, for all the retirees who have very low risk tolerance and who have very clear objective of generating income for their post-retirement living, advising them investing in highly risky financial assets, especially derivatives, for instance, or the CDS market, for instance, this kind of highly risky financial products will not be considered appropriate. So under these standards, you are supposed to have a good understanding of the investor's circumstances and provide advice that's suitable for that clients. And also the next standard, duties to clients' performance presentation. So you do your best to represent your historical performance and give expected return of the portfolio to your client. You cannot provide misleading information or misrepresentation of your historical performance. For instance, if you have done really well in the past several quarters and you put it into your marketing materials in a way that may make your investor believe this kind of performance will be very likely to be repeated consistently in the future, and this can be a misleading information in the marketing materials. So the way you present your performance, your historical performance, the way you use this information are important for the clients to make their investment decisions. So these, the principles should be a fair representation, accurate and complete. Usually this is defined by the company. So for example, if you go to have a look at the Colonial First or AMP, these large investment companies, for each financial product they provide to investors, they have a format of presenting this historical performance or discussion of the historical performance to avoid this kind of misleading information or errors. And also you will find the disclaimer at the end of this fact sheet for each financial product. So these are pretty much standards in the industry. And another standard, the conflicts of interest. So when there are possibilities of conflict of interest, first of all, you need to disclose, full disclosure to your client. For example, if you receive kickback, you receive commissions, brokerage, anything that might lead to the inappropriate advice to clients or not behaving for the best interest of your clients. Disclose first, and also when there's opportunities, investment opportunities, you act for the interest of your client first. So in some instances, for example, if a manager is managing a separate mandate for high net worth clients, when they have foreseen something the market's going to happen, for example, if they believe there's a very high chance there will be high-level conflict between China and US because of the trade tensions, and they have really a bearish view of the equity or any stocks with substantial exposure to Chinese economic development, they're going to sell, for example, reduce the stocks within the portfolio for the clients first. So at the same time, they might be managing the company's portfolio as well. Then they try to reduce the exposure to the Chinese economy second. And lastly, if they want to trade their own personal portfolio, given if they have the approval from the management, and then the manager can do so. So always act or trade for your client first, then probably company's portfolio, then the fund manager's personal portfolio. So when there's conflict of interest, and you make full disclosure and act for the best interest of your client first. Any fees you receive, you have to make full disclosure as well. This is pretty much a requirement for financial planners as well. For the asset managers, there are dedicated code of professional conduct. So these are professional conduct you are expected to comply with. If you provide misleading information that leads to substantial loss of clients, you might be involved in lawsuit. But in some instances, it's kind of a gray area. It might be not defined as illegal, or it's just poor professional conduct. That's probably, in some instances, you're not involved in lawsuit, but CFA, like if you're Manda, if you're charter holder of CFA, you're going to be sectioned by CFA Institute or within the professional body. So this can be a penalty, that's a damage of your professional reputation, and within that circle, you're going to be known to the professionals in the industry. So the professional conduct, sometimes it's not serious enough when it's illegal. It's like, for example, the performance report is not 100% complying with the requirement of your employer, and you probably get warnings, get some sort of penalties, but you won't be chased by your clients. So these are the guidelines that you probably want to pay attention to in terms of your professional interaction with your clients. When you present your performance and interacting with your clients, communicating with your clients. Following this, I give you a few examples that in some circumstances, this behavior might violate the professional conduct or not really good practice by the CFA ethics. So you may have a look at these examples by yourself, and there might be something similar in the final exam. I have not decided yet, but at least I have some reading of this and try to understand the principles when you communicate or interact with your client for the best interest of your client first. The fund governance is a very important issue for institutional investors. When we talk about governance, you probably had some discussion of corporate governance in corporate finance course. So when we talk about governance, we mean an organization, a structure, how it is managed, and who is responsible for what. And there will be monitoring involved, and will be delegation of authorities, delegation of decision-making involved. So with a fund, especially institutional super fund, the fund governance is somewhat different from the corporate governance structure, like for-profit organization like companies. For example, for any listed Australian companies, of course, they have to follow the rules of ASIC. For instance, they have a certain proportion of directors as being independent directors, and they have the compensation committee and so on, nomination committee to organize the whole things of the board. But with super fund, remember this, the monitoring from members is minimum, and it's very hard to enforce any monitoring from members. With the shareholders, when they're not happy with any directors, they can fire that, and they're not going to be elected to the board anymore in the next term. And also, in some very rare circumstances, these directors can be held responsible for the loss of shareholders. But this is very difficult, because all of the directors, nowadays, they have their professional insurance. So the company will pay, that's the money from the shareholders' pocket, to pay for the directors of professional misconduct. So if anything happens, that, for example, if some of the directors fail to act for the best interest of shareholders, or they are involved in certain misconduct, the insurance company will step in to compensate the shareholders. That's usually the case. It's extremely hard to chase the directors for their personal compensation from them. But for the UniSuper, for instance, for the super funds, I'm a member of UniSuper, and all of my colleagues within the university, they are all members of UniSuper. But we were never involved in selecting the directors of UniSuper, and we are never involved in monitoring the members of directors of UniSuper. So there's a break of the monitoring of members who receive the benefits of the super fund and who sit on the board and look after the management of my wealth, my super fund, and evaluate the performance of investment staff. So that's the key issue for the institutional investors, especially super funds in Australia. This has been a lot of things have been done by the government body like ASIC, APRA. They have been trying to introduce new rules to hold the directors of super funds responsible for their behavior. But it's really hard to define by legal term to what extent they're going to be held responsible for. For instance, if I'm a member of DC Fund of UniSuper, so if there's really a bad performance for the past several years, it's really hard for me as a member to hold any member of the board to be responsible for that performance. So the maximum thing that can be done that some of the investment staff might be fired, replaced by the board, but there's very limited I can do. Although the government has been trying to do this, improve in this area, but a lot more needs to be done in the future. So, especially for superannuation funds, governance does matter. That's the academic have done this research. They compare the average performance of institutional investors with so-called good governance behavior. So with the good governance behavior, they probably will have a diversified expertise of the board of directors, and they have a good structure managing the governance of the board and monitoring the management. So with this good governance institutional fund, they do find a higher performance. So that's it's a range of 1 to 2% per annum. So it looks like a quite big margin that, okay, so the good governance funds outperform the bad governance funds. But be careful if you try to make any inference or try to use this in the fund selection, because with larger funds, they usually have more resources, more expertise, more HR, more resources will be involved in enforcing the monitoring of the investment staff and having more resources and more access to good quality directors. So that will result in better governance practice. And with these larger funds, and they tend to have better deal to negotiate brokerage with broker firms, and also they have more resources in their security selection and borrowing at lower cost. So these firms tend to outperform the so-called bad performance, bad governance funds. So good governance is not a guarantee of outperformance, but good governance might lead to the avoidance of the cost associated with bad governance of managing the super funds. The key players, when we talk about the governance of institutional investors, are usually the board of trustees. They are responsible for setting the objective of the fund, the mission, objective, or whatsoever, and they decide investment policy as well. And they are responsible for selecting the chief investment officer, the high-level investment staff of the fund. And then the investment staff are responsible for the performance, the day-to-day management of the fund and reporting to the board. And also investment managers will be involved. That's part of the investment staff. Investment consultants are usually external parties. They are hired by the fund to advise on one particular asset class, or one particular assignment or task. The custodian of the assets, usually the large investment banks will be involved, and of course you have to pay a fee. They provide the information of your asset value, and sometimes they provide accounting system or asset management system so that you can generate all kinds of reports quickly and efficiently. So these are the parties involved in a fund, and they are responsible for different things within the fund. The key governance issues, especially for superannuation funds, just as I discussed, the monitoring of the board of directors is very difficult, and the board is usually not held responsible for their own bad decision or inappropriate monitoring of the managers. And also the responsibility between the board and the investment staff. Sometimes with smaller funds, there's a fuzzy definition or clear cut of who will be responsible for what. With larger funds, there will be clear procedure. For example, if there's a need for rebalancing the portfolio or changing some weights, there will be reporting procedure from the investment manager to the chief investment officer, and then they're going to talk to the board and seek approval from the board if they are able to change the asset allocation. But for smaller funds, where a very small team of people involved, this process can be very efficient. The decision can be done over a very short period of time, maybe a few days, but who will be responsible for the changes is going to be difficult to define. With larger funds, especially institutional funds, the conflict of interest will inevitably arise. For instance, due to the personal relations of some management staff with the brokerage companies, they may direct the business to their preferred brokerage firms. In return, they probably won't be able to receive the cash as a bribery or commission, but in return, they may receive a paid holiday from the brokerage firm, for instance, or they may receive favor from the brokerage firm in other channels. So these are very difficult to detect or regulate from within the governance structure. But this impose great conflict of interest and might lead to substantial loss for shareholders. The member equity issue. So we have discussed about the member equity issues in the context of direct property fund. So because of the lagged nature of the valuation of direct property funds, the unit price is inaccurate or is subject to the manipulation of the fund manager. So this might lead to wrong calculation of unit price, so wrong calculation of number of units if you make investment with the fund. So due to the inaccurate valuation, you may receive more units than what you deserve, or sometimes you receive less units than what you deserve. So another aspect of the member equality issues is the intergenerational issue. So that's particularly the case for DB funds. Why is that the case? So you consider that with the DB funds for the baby boomer generation, they started retiring since 2012, around that year. So after that, until now, lots of baby boomer generation, they enter retirement, they become net receivers of the benefits from DB funds. So we understand that with DB funds, you make contribution, and the benefits you receive when you retire is not tied to the performance of the fund. It's actually calculated based on your age, your years working with university, and the average salary wage in the 5 years before you retire. So these factors will decide how much money you're going to receive if you're going to have a lump sum or annuity when you retire. So the baby boomer generation who have retired, they are receiving benefits. For younger generations like me, if I'm a member of DB funds, I'm contributing, I'm not receiving any benefits right now, and I'm not quite sure how much benefits I'm going to receive when I retire, because the laws are governing the DB fund may change in the future, and also we know what happened during the global financial crisis. When there was a huge deficit in the UniSuper DB fund, the baby boomers, the retirees, they kept receiving the benefits promised by the DB fund, no matter how the fund had performed during the global financial crisis. For younger people who are net contributors into DB fund, they are subsidizing the retirement of the older generation. So that's what happened in the past 10 years, and I think that's mainly the reason that I decided not to be a member of DB fund. I would rather looking after my own retirement saving, and it's set in my own account under my own name. I don't want to subsidize the older generation. So that's probably a quite unique issue for the DB fund. I don't have the graph now. Just recently, I think if you do a Factiva search or just do a Google search, you probably will find the news story that the baby boomer generation, the retirees after 2011, they are the net receivers of cash refund of imputation credits, and they're not paying tax. They take quite large proportion of benefits out of DB fund. So that will be a problem in the future when the government budget is under pressure. So probably the government will be very reluctant to make up any deficit in DB fund. If there's any substantial market downturn happens in the future, the younger people will be just subsidizing the retirement of people who have retired. And this will affect their own retirement in a very negative way. Next, we're going to talk about another important issue in managing a portfolio. Actually, some groups have been thinking about advising the rebalancing issue in the asset allocation advice. So the rebalancing question is something that we're going to evaluate it using a few hypothetical examples and give you some guidelines. Because this course is about asset allocation, we don't deal with the details of portfolio management. So we're going to touch on that to give you some ideas of how the balancing should be determined in general. The exact decision will be subject to a lot of factors. So here, the first example, I'm going to use the actual experience of Australian investors during the global financial crisis. So we're going to start the case from the end of 2007. And we're going to have a look at the performance of investors' portfolio over 3 years of time, from 2007 until 2009. So over that period, we understand in 2008, we had a market downturn, especially in Australian equity, negative 35% around that return in Australian equity. After that, in 2009 and 10, we had a quite impressive market rebound or market recovery in Australian equity. So that's what actually happened in Australian equity market. That's the major asset class within this hypothetical Australian investor. So you probably will see at the end of 2007, we have an investor with asset allocation of this 70-30 growth to safe assets. So that's a typical balanced portfolio with major asset allocation in Australian equity. Over 2008, the height of the global financial crisis, and that's the return over a year for Australian equity. So over 2008, we'll see the value of that Australian investor dropped to $828 million. And you will see the weight of Australian equity dropped from 55% to 42%. So if we assume the end of 2007 weighting is a long-term strategic asset allocation, that's probably what we want to bring back to if we decide to rebalance our portfolio. So at the end of 2008, obviously, Australian equities got hit hardest in all of the asset classes. So that's a drop of about 13% of weighting within my total portfolio. And that's the experience of investors' portfolio if you do not rebalance. So if we rebalance the portfolio at the end of 2008, so over the year, Australian equity experienced negative 36% of return, and we want to bring this 42% back to our long-term strategic asset allocation of Australian equity, which is 55%. So you're going to buy additional Australian equity and bring that weighting back to 55%. So if you do decide to rebalance at the end of 2008, you're going to end up with the same asset allocation as in 2008. But to rebalance your portfolio back to the desired weighting, you are buying Australian equities by selling direct property, that's negative, selling fixed income as selling cash instruments. So you are selling the assets, the direct property, fixed income and cash to finance the purchase of Australian equity, to rebalance your portfolio. That's if you go ahead with the rebalancing and you are doing these trades, buy and sell. So what will be the impact of the decision to rebalance the portfolio at the end of 2008? Here's the first half of the table shows the outcome in 2009. So at the 2008, I rebalanced my portfolio. I brought back my weighting of Australian equity back to 55%. And over the year 2009, that's the recovery of Australian market, and you will see the value of Australian equity increased to $569 million from this $455 million. So obviously, this is a net gain in Australian equity. If you compare the total value of rebalancing decision, you're going to end up with $940 million asset value within your total portfolio at the end of 2009 after rebalancing in 2008. So what if this is a market recovery? What if I didn't rebalance my portfolio at the end of 2008? I'll stick with this asset allocation like this. I do nothing. I do not rebalance my portfolio. I'm just go into 2009 with this asset allocation. This is substantial deviation from my strategic asset allocation. You're going to end up with $950 million. Obviously, compare this number with the portfolio value if you rebalance your portfolio at the end of 2008 or before the market recovery, you're going to be better off rebalancing your portfolio. Why is the case? So obviously, if you do expect there's a market recovery, especially in the major asset class of your total portfolio, you rebalance your portfolio will be better off. That means you're going to take the full benefits of the market recovery. So that's the why rebalancing of your portfolio will end up with a positive excess return over the decision not to rebalance your portfolio. So that's the case that market is expected to go over a mean reversion, or in this case, after a market slide, and you're going to have a market recovery. So over 2 consecutive years, rebalancing will end up with excess return compared with not rebalancing your portfolio. If you want to have a full recovery of your loss over the bad years, for instance, how much return will be needed? We did something similar in week 2 workshop. So because of the loss in 2008, you end up with less money in your portfolio. So when you start 2009, you have less amount of money within your portfolio. So instead of the market recovering by 36% in 2009, you actually need a much higher positive return in 2009 to recoup all of the losses you have made in 2008. So that's what we have here in the lower part of the table. If you want to, in 2009, recoup all of the losses you made during the global financial crisis, that means you're going to go back to the original asset value when you started at the end of 2007, you need at least a 56% of return in 2009. So that usually is very hard to achieve. What if the market will continue its downward trend for another year? For instance, if the market is going to have another year of negative return in 2009. So that's a return in 2008 and return in 2009. That market will be trending downward, continue for another year. And you'll see if I don't do anything, I don't rebalance my portfolio, I'll just live with this asset allocation, lower asset weights to Australian equity. At the end of 2008, I do nothing. I do not rebalance my portfolio. At the end of 2009, another year of loss, significant loss in Australian equity. I end up with lower value of my total portfolio and even lower weight in Australian equity. So that's if I sit through a market trend, I'll end up with even further deviation. That's what you have here. Further deviation from my strategic asset allocation. But is that something smart to do in the trend market? What if at the end of 2008, I rebalance my portfolio? Will I better off, get any benefits if I rebalance my portfolio at the end of 2008? So to rebalance at the end of 2008 means that I need to bring that 43% exposure to Australian equity back to 55% of my total portfolio, which means that I need to sell assets of direct property, fixed income, and cash instruments to buy Australian equity so that I can restore the asset allocation of 55%. Will I better off at the end of 2009? Not at all. Because if you expect there will be a negative return in 2009, that's a major asset class within your portfolio. If you rebalance your portfolio, you try to bring the exposure to Australian equity back to 55%. You are putting more money into loss-making asset or asset classes. So when you expect the market will trend, you tend not to do anything. You tend not to rebalance your portfolio. That's an example of a negative trend or 2 consecutive years of negative return. What if there's any rising market? If, for example, this year we have about around 30% of gain in the Australian equity market, if I'd expect there will be another 30% of gain in the Australian market, do I rebalance my portfolio? Are you going to rebalance your portfolio? Do you rebalance your portfolio if you believe there will be another 30% gain next year of Australian equity? Good, very good. So if we are in a rising market, so obviously after a year, our asset allocation of Australian equity will be exceeding this 55%. Might be 65% or 70%. Do we rebalance our portfolio by selling Australian equity? We don't, because we foresee another year of gain of Australian equity will sit on the, for example, if it's a rising market, we're going to have 70% exposure to Australian equity. We just stick with that asset allocation for another year. If you want to rebalance, you have to sell the Australian equity, which will experience significant positive return in the next year. So no matter it's a market that's rising or going down, when the market is trending, we tend not to rebalance of our portfolio. of course, the rebalancing decision will depend on your forecast of the market movement in the next year. So there are some circumstances or considerations you probably want to think about before you make that rebalancing decision. So if the asset allocation is still within the range of your strategic asset allocation, you probably want to just wait and see for another while. Usually the strategic asset allocation is a range that you will find with a lot of institutional investors, and they have very cores of asset allocation, for instance, equities, fixed income, and they have this 70 to 30 growth assets to safe assets. There might be some flexibilities within that asset allocation. And if the market tends to trend rather than mean reversion, you probably would not rebalance your portfolio. You try to sit out of that trend. Or sometimes when rebalancing is too costly, large transaction cost will be involved, or your sell or buy order will move the market price, or sometimes just because the asset involved is illiquid, you have to offer a large discount to sell that illiquid asset in the market. So after evaluating the potential benefits and cost, you probably want to just stick with the suboptimal asset allocation. And there's an interaction with the risk tolerance, especially when in the rising market, when investors observe their wealth is increasing quickly, they tend to have lower risk tolerance. So this is not a linear relation. So when we involve the behavior of investors in the decision making, that's usually non-linear relation. So it doesn't mean that the portfolio of wealth will increase by 1%. There's a proportionate increase or decrease of risk tolerance or the probability of certain investment decision-making behavior. Of course, one investor has a very strong view that suggests rebalancing is inappropriate. For example, if you do have strong belief that we're going to have another year of positive gains in the Australian equity market, you don't rebalance your portfolio. You don't sell Australian equity. You just sit tight, of course. Sitting tight with the current suboptimal portfolio, this comes with higher risk. So higher weighting of Australian equity, the total standard deviation of your portfolio will be higher as well. So this should be considered by investors given their own evaluation of risk or their circumstances. The performance evaluation, they are actually discussed in multiple finance courses. In our assignment in this course, we have covered several aspects of performance evaluation from the perspective of asset allocation, evaluating our portfolio against a benchmark or comparison group or a benchmark portfolio. So that process usually involves the performance attribution. So we try to identify of the total return of investors' portfolio, how much of that total return is driven by the general market movement. So we can run regression of investors' total portfolio return against several market index, for instance, Australian equity index, Australian fixed income index, and risk-free rate, so that we can identify how much of the total return variation is driven by these factors, and how much of total return variation not explained by these factors. So if there's any excess return, can we explain the excess return with skills of the managers or luck or whatsoever? So if there's a well-defined benchmark, when we evaluate the performance of the managers, especially try to attribute the active returns, we do the calculation of, for example, tracking error, information ratio. You have done that already in the assignment. So try to make some sense out of that, especially when you do portfolio tilting, overweighting, underweighting of your portfolio against the benchmark. This will be a very good exercise. Understand the usefulness of these performance evaluation techniques. In a lot of circumstances, the performance evaluation will come with some issues. For instance, if the benchmark is an appropriate benchmark. For instance, when some groups try to maximize Sharpe ratio in the mean variance optimization, so the implied assumption of using a Sharpe ratio in performance evaluation is actually benchmarking the investor's portfolio relative to risk-free rate. The Sharpe ratio is the ratio of the excess return of investor's portfolio over the risk-free rate over the standard deviation of the investor's portfolio. So you are trying to gauge the investor's excess return over risk-free rate for 1 unit of standard deviation of the investor's portfolio. Actually, you are using the risk-free rate as your opportunity cost. What if I invest the funds in the risk-free market, for instance, Australian government bonds, and then what will be the excess return generated by my portfolio? There are some inherent shortcomings with using this kind of ratios. For investors, it's going to be quite difficult to interpret the unit of that ratio for every unit of standard deviation. So what's the implication of every unit of standard deviation? What will be the impact on investors' wealth, and how they're going to evaluate this? So use of Sharpe ratio is difficult for investors to interpret the results. That's why in practice we have another performance evaluation ratio, which is Modigliani squared ratio. It uses Sharpe ratio to calculate. It's used Sharpe ratio of investors' portfolio as an input to calculate this alternative measure of performance. A positive Modigliani squared measure will indicate a positive excess return over the risk-free rate. So the unit of that ratio will be return, a positive excess return. And also for investors, who, especially for the active managers, they're given a passive index as benchmark. They evaluate every single unit of peer risk, how much active excess return they may generate by using the information ratio. So this is particularly useful in evaluating the marginal benefits of portfolio tilting, overweighting, or underweighting. So you probably have done this with your assignment. The portfolio performance excess return. So this is a quite general representation when we say excess return of investors' portfolio against the benchmark. It's a difference. But actually in funds management industry, and also in this course, especially for your assignment, that arithmetic difference is not a preferred measure of excess return. We have discussed this in week 2 workshop, the difference of compounded outperformance and the arithmetic difference like this. So why we prefer the compounded outperformance of investors' portfolio against the benchmark. If you have forgotten everything about this, review the workshop in week 2. For most cases in funds management, when we have capital inflow, outflow of the fund, the compounded outperformance will give us a better, more accurate reflection of investors' performance against a benchmark, instead of just the arithmetic difference. Okay, I think I'll just finish off, then we talk about the exam in the second half of the lecture. The last topic is not going to be tested in the final exam, but I want to bring your attention to the most recent development in wealth management. So basically, up to here, we have been discussing the asset allocation decision in the context of classic finance theories. So the modern portfolio theories, the efficient market assumptions, and all of this, and we have assumed investors are rational. That's our assumption of investors. Although we have touched on some topics, like in real life, investors' objectives are much broader than the simple trade-off of risk and return of their portfolio. And we have some alternative asset allocation approaches or considerations to help us to fill in the gap when we apply the classic finance theories in practice. But here, I'm going to introduce some new ideas. Behavioral finance is actually something totally different from the classic finance. And behavioral finance is not part of finance or the finance you learn at school right now. So the major difference is actually in behavioral finance, they assume investors are normal. They are not rational. So when we mean normal, that means that we're going to have sometimes overconfident. Sometimes we are pessimistic, and we overreact to both good news and bad news. And sometimes got really panic and make wrong investment decisions because of this behavioral bias. And so that's the assumptions of behavioral finance. The theories and the ideas in behavioral finance, they challenge even the basic assumptions of classic finance theory you learn from all finance courses. So the behavioral finance, if you want to have some basic understanding, you might start with a Google search of these names. Even a Google search will give you some basic ideas. If you want to learn about this, you might start from reading their papers. And I'm sure you will find some behavioral finance textbooks by some academics. So based on their belief that investors in the investment decision-making process are not rational, they are normal. So that means they're going to make wrong decisions. For instance, one behavioral bias will be overconfidence. For example, I'm an academic. I've been learning finance for a very long time. I've been working in finance for many years. I'm just so confident about my security selection skills. I always believe my investment decision, my portfolio, that's an actively managed portfolio, will beat the market even after fees and applicable taxes. So I will be actively trading, buying and selling, and testing my ideas in the Australian equity market. So that's one particular bias for a lot of investors, especially traders. They have overconfidence of their skills and their knowledge. So this will lead to there will be on average, no outperformance against the passive index, and they just created a lot of brokerage fees and created a lot of business for the brokerage companies. So that's one behavioral bias. When investors are overconfident of their knowledge, their skills, they make wrong, inappropriate investment decisions. Other bias, for example, representative bias, it's human instinct that would put more weight on recent events. If this is an example from done by a psychologist. Immediately after the global financial crisis, they ask investors to give a forecast of the market performance in the next 1 or 2 years. They will give a quite negative estimate. They tend to be they held relatively negative view of the market performance just immediately after global financial crisis. But when the share market experienced some consecutive quarters of gains, when they sent the same questionnaire to the same group of investors, they tend to give more positive forecast of the expected return of the equity market. So that will actually point to a representative bias of investors' behavior. When they just have experienced some losses or gains, they're going to put more weight when they form their forecast for the future. So on some aspect, you probably will think, okay, this is reasonable because it's fresher data. But usually investors tend to overweight this recent experience in their forecasting. So maybe in some instances, a very considerable long-term average will give you some balance against this kind of bias. There are other bias. If you're interested, you will find lots of materials online to have a rounded understanding of all of the bias. There's a very long list of this kind of behavioral bias. So to incorporate this investor bias into asset allocation is quite tricky. There are some guidelines that how you may incorporate this into asset allocation. Of course, logically, the first thing is to identify the particular bias of that particular investor. Have you had the chance to look at the investor questionnaire of Vanguard? Have you? It's free, available online. So you may do a Google search, have a look at the questionnaire from Vanguard. So there are a few questions involved. From that question, they try to assess the risk tolerance of investor. That is very rough questionnaire. It only gives you a very rough gauge of investors' risk averse, but it doesn't point to any behavioral bias. Nowadays, more and more financial planners and investment consultants are using behavioral-based questionnaires. They try to assess how confident that investor will be, and they ask very specific questions. Given this circumstance, what will be your investment decision and what will be your perception of risk? So with this behavioral-based questionnaire, they try to assess not just risk tolerance of investors, but also the behavioral bias of these investors. Then later on, they might incorporate this in their asset allocation decision process. Unfortunately, I cannot find this kind of questionnaire. They are proprietary material of the financial planners or investment consulting firms. I cannot find something relevant or useful to use. So I only read this from some books in the US market. So if you're interested, you probably will come across this kind of behavioral-based questionnaires. And in the recent years, at interviews, you probably, if you have been at interviews, you will find in recent years, the HR people, they are increasingly asking you behavioral-based questions. So they're going to ask questions like, what's the most challenging thing in your previous job, and what did you do to overcome that difficulty? So these things will be very important for people to understand your personal traits, your personalities, and your resilience when you face difficulties, and how you're going to deal with these challenges in life. So the behavioral-based questions will be the future trend in the future when you try to assess the investor's risk tolerance and their behavioral bias. If we push the boundary even further, so we might have a fairly good understanding of the behavioral bias of investors and try to incorporate this in the asset allocation. There are even more advancement in neuroscience that they combine the tools of neuroscience, psychology, and finance economics together to help us understand how investors make investment decisions. So to put this quite fancy words in a context, that will be some experiment that they're going to have a screen in front of a group of investors or study subject, and they're going to put sensors on their brain, on their fingertips, around their body to test the blood pressure, the activity of the brain, and then ask them to make investment decisions. So all of the neuroscience data will be collected and analyzed, and to try to help us understand when investors make investment decisions in this way, in these circumstances, which part of the brain is more active, and which part of the brain will be more important than other parts in their decision making. So that was developing very quickly in this cross-disciplinary research field of behavioral finance or behavioral economics. So that will be the end of this lecture. We discussed a few topics that most likely to form your knowledge in this area or future development in this area. But when you go to prepare for the final exam, only focus on the concepts, especially the decision to rebalance investors' portfolio. Don't need to pay much attention on the fine details. Only learn about the behavioral finance if you are interested. So it will complete our knowledge about asset allocation in terms of incorporating investors' behavioral biases, but it's not going to be examined in the final exam anyway. The final exam, since there will be a big question in final exam in a similar format as the assignment, so it's essential that you're going to get your feedback of the assignment and have the chance to talk to the tutors or me about anything misunderstanding of your assignment before the final exam. So my plan is to finalize the assignment grades in the week of the 10th of June, but I think 10th of June is a public holiday, Monday. So during that week, you're going to expect to receive the grades on WhatsApp or an email from me, so that in the following days, about at least 1 week of time, you're going to have the chance of additional consultation with tutors and me to discuss your assignment or ask questions to help you to prepare for the final exam. So that's what we're going to do leading up to the final exam. Next, we're going to take 10 minutes break. Then after that, we're going to talk about the final exam. You will have this, some brief information about the final exam on WhatsApp, and I give you a few slides, oh, it doesn't show my graphs. So these materials are already available on Water. If you're interested, you can have a look and ask questions in the second half of the lecture. Now, let's just take a break. It's like the session. Need to all invest. I mean, so I mean, other this. Go. Mm-hmm. think that's properly. Academic is yeah. I believe there is a lot of report. It's going to be continuously to improve. Than one. What will be the portfolio outcome? It's okay. Is the current portfolio can be a comparison of this recommended portfolio, but below that portfolio outcome. What I'm worried about? What will be my it doesn't matter. It doesn't matter. So what I'm summary is like this. This is your the outcome in this one. See, all of my are satisfied. Then your purpose. At least put in there. name it? What to put? Sentence before. Risk. Percent, 80%, 70% state
Yep.
is risk. As a consider the substantial substantial maybe this one or that one. So your of that list. It's not.
So like
Well, analyze.
yep.
Commodity. Abstract. Say. Context.
I know. It's on the
Percentage to this percentage.
this, but just one. unless section. Yeah, I do. Then that's fine. Some teams have. That's fine. Is general thing. General thing. Yes, sure. Okay. Hurry up. Thank you very much. Thank you very much.
One last question. Benchmark to
This-
group. Just
Okay, something very exciting, the final exam. So in the final exam, there will be 60% on written questions, 40% of multiple choice questions. With the multiple choice questions, there are 20 out of them. About, I have not decided yet, maybe 5 to 6 will involve calculation. But the calculation will be something similar as what you did in the mixed method exam. They are straightforward calculations. And they are very likely to be portfolio performance, the relative performance calculation, or calculation of tracking error, something like this, quite straightforward, but something that are essential in asset allocation or portfolio management that you are supposed to understand or you are supposed to be able to do with a calculator. Or maybe I'm still thinking that I'll ask you to calculate the equilibrium forward contract rate in the multiple choice questions. That's what we have discussed in week 10. That's about the hedging decision. But it's not, if it's involved, it's still going to be straightforward, not in a very complicated format. So don't spend too much time writing down the formulas in your cheat sheet unless you have worry about doing this in a very simple and straightforward way. I'm not going to ask you to calculate hedge ratio, punch in the calculator, plug in the numbers, but it will be in the written part. I'll ask you to apply this hedge ratio to make investment decision for a client. So don't worry about calculating using that formula. The materials covered will be from week 1 until week 12. They're not going to be strictly evenly allocated, but I do not have an emphasis of the second half of the course. Because the first half of the course, the mixed method exam is optional and redeemable. I don't want to downplay the importance of the first several weeks in the final exam. So you probably want to review the first few weeks with the last the second half of the course. There will be a big question. That's 20% of the total exam. So within that question, it's in format as the assignment. So I'm going to give a client case. I'll give you very detailed information and the client circumstances and ask you to give asset allocation advice. So the practice you have done writing up the assignment report and doing all of the modelings, playing with the weighting and try to testing out your ideas won't be wasted. So in that big question, you are supposed to write about the justification of approach selection, data selection again, and very specific questions of asset allocation decisions. For example, last week, I think I give you a past year exam question. I give you a client, objective, investment horizon, and I have an asset allocation of 10% in property and ask you to advise on the asset allocation of direct property and the listed property and ask you advise which one is more appropriate for the client's circumstances. So that will be something you would expect in the final exam. No modeling or calculation will be involved. So you don't need to worry about these details of how to calculate the returns, how to roll them over multiple periods, how to calculate geometric means in the written part. But all of the concepts, all of the choices, the justifications you have practiced in the assignment will be tested. So I understand some groups allocate your tasks by someone will be writing, someone will be modeling. So you probably want to work together, sit down, and try to share your experience, share your knowledge. Otherwise, you're going to be put into a disadvantaged position in the final exam, especially the people who are doing all of the modeling in the assignment. Things that you might bring to the exam, notes, A4-sized note. You might have notes on both sides and it can be typed. So it's up to you to put anything into that notes. Very important, dark color pencils. I was asked by IT department to let students fill in the multiple choice answer sheets with black pens. But I suppose using pens will be quite difficult to change in the exam, so make sure you bring a dark color pencil. And in the mid-semester exam, I manually marked like 10 multiple choice answer sheets. Like, for example, that's the circle you're going to fill in. Some students will do something like this. Oh, that's probably that one. Some students will fill in like this. That's not going to be scanned properly, correctly by the machine. Or sometimes you fill in something like this, it doesn't count. And if you're going to change your answer, you just need to use your eraser really hard and get it cleaned. Otherwise, the machine will produce a wrong result. So I did check some of these suspicious multiple choice questions answer sheets. I did find errors. So don't put yourself in a negative way due to these human errors. Make sure you fill in the circle like this. It's so funny I have to say this in class. You have to fill in the circle like this. Use a dark color pencil. So that's something very important. And don't forget to fill in your student number. Every time we have the exam, there are always some students forget to fill in the student number. Sometimes they write the number on the top but forgot to fill in that circle. So the preparation of the final exam, I give you a list of topics on water, of the topic areas of all of the 12 lectures. Of course, there are more important lectures, for example, week 2, 3, 4, 5 until 10, maybe 11. The first lecture and the last lecture are less important in terms of maybe 2 or 3 marks will be involved for each of the first and last lecture. Focus on the lectures in the middle if your time is limited or if you have a lot of things to catch up. And also focus on the key concepts. You might use the lecture slides as a framework for the review, but by simply reading the lecture slides doesn't work for the exam in this course. So to understand the full picture, you have to read the complete article, especially the examinable readings. You have to read through the whole article, truly understand the concepts. And in the lecture, you probably have found out, we talk about these concepts, ideas, and there will be also sections we talk about the applications of these concepts and these principles. And also in your assignment, you apply these ideas, concepts, or principles. So when you review the ideas, like, for example, the data selection or sample period selection or data interval section, we talk about the principles in lecture, and you did the exercise in tutorial with the numerical calculations of the investment horizon effects, and you did apply this, all of the considerations in the assignment. When you come across any concept, think along this line. These are the principles or theories we discuss in lecture, and in tutorial, you probably have some exercises around these topics to give you some better, deeper understanding of the implications of the concepts on the investor's portfolio, and then apply this in your assignment. So always the concepts, the tutorial exercise surrounding that concepts to give you more numerical examples, deeper understanding, and then finally the application of that concept in the assignment. So for most of the concepts, you have to understand in this way. If you feel confident on 3 aspects of all of the major concepts, you should be okay for the final exam. Any questions? No? And very important, the strategy of doing the exam, you have 15 minutes of reading time. Read through all of the questions, including the multiple choice questions and the written questions. Allocate your time, do the questions fast that you have more confidence. In the mid-semester exam, I gave you a bonus question, which is the last one. A lot of students didn't really get mark from that because they didn't have time to answer that. But that question probably the easiest one. You can get some marks, at least half of it, by copying from your notes. So pay attention to this kind of bonus question in the final exam. When you probably will just simply copying from your notes will get at least half of the marks. If you have no idea how the calculation should be done, just skip that or just guess a result. Don't spend too much time on the multiple choice questions. Each question is worth 2 marks only. But if you have a roughly very good understanding of the concepts or very good writing skills, spend more time in the written part of the exam. There will be additional consultations from the tutors after the assignment grade is finalized, before the final exam. And also, I will hold additional consultation every Wednesday morning from 9:30 until 11:30. So you can still come to see me next week during the exam period until the final exam. But before you come to see me, don't sit down in front of me, ask me to explain what's investment horizon effects, what's fundamental risk approach. I do not answer these general questions. You have to make sure you reviewed all of the required materials in this course and ask me very specific questions, ask me to clarify anything that makes you confused. And also, even yesterday and today, some students asked me questions like, after calculating the rolling returns, what shall I do? I didn't answer that question. What shall you do? Maybe just, you're supposed to work it out yourself. That's a part of the objective of the assignment. Do not use me as a shortcut. That's not appropriate learning. You have to go through the materials yourself, ask questions. If you cannot solve the questions, I'm very happy to help. But I'm not going to repeat the lecture or repeat the workshop or tutorial again for you, just in my consultation. Any questions about the format of the exam or how you're going to prepare for the exam? Any questions? No? Anyone tried to answer the last year exam question on ECHO? Anyone? We'll have a look. If there's some response there, we can talk about it. If no one has tried to answer it, I'll leave it to you to answer. I'm not going to give you a correct answer so that you can copy in the final exam. So again, I have problem using this, just presenting graphs, even this PDF file. I don't know why. So here, I give you a brief revision. There are a few slides. These are taken from past lecture slides. These are usually the most tricky things that students will be more likely to make mistakes or find very difficult in the final exam or in the preparation of the final exam. So understanding, the first one is the understanding of interest rate risk and credit risk in the fixed income portfolio context and total portfolio context. So I don't have the graphs shown here. So the implications for investors will be in multiple folds. For instance, if the institutional investor, for instance, super funds, they hire a specialized team of fixed income managers, and they give them for example, absolute return target and certain risk constraints, and ask the group of fixed income managers to manage that separate mandate following these requirements. The way that fixed income managers evaluate the risk of the portfolio will be totally different from the risk at the total portfolio level. So the implication will be that when interest rate is involved, what will be the different implications? And when credit risk is involved, what will be the different implication involved? Think about this and still follow the track that here in lecture, we presented the ideas, like for fixed income managers, when you increase interest rate risk, it tends to increase the fixed income portfolio standard deviation. But at total portfolio level, that interest rate will be not necessarily increasing total portfolio risk. And think about why and how may you utilize these concepts in advising asset allocation or assessing the risk and return trade-off for a client. For example, the client in your assignment or your imaginary client. So this is quite confusing part. The second topic is about the commodity futures price. And also here, I also would like to highlight that a lot of students I don't know why you still hold the view that commodity and gold can be inflation hedge. That was the case 40 years ago, but still some students are asking for gold and in gold price and index ask me to give them an expected return of gold as the inflation hedge or other purpose. So make sure you review the materials of the commodities and have a better, deeper understanding and also the updated understanding of the contribution of commodities and gold in the total portfolio context. They used to be a good hedge against the inflation 40 years ago, probably 30 years ago, but not now anymore for a reason. Go to review that lectures recording and slides and make sure where you are on the right track, understanding commodity and gold. And on top of that, the theory of storage and theory normal backwardation, they are not going to be required in any calculation, but at general conceptual level of why the futures price is important, because it forms part of the excess return that commodity investors receive. Here, commodity investors are actually commodity speculators. So what they receive, they expect to receive by investing or speculating commodities in the commodity market or becoming the counterparts of commodity futures contract is this. So they are looking for that risk premium or compensation for bearing the counterparty risk in the future, in the commodity futures market. So because of the financialization of the commodity futures market, this have been a significant downward pressure on that risk premium. So it sometimes is negative. And you probably don't want to expect you're going to generate a large excess return from commodity market anymore for average investor. And commodity investment is not appropriate for every investor. Some investors or some professional investors, they are very good at forecasting commodity prices. Not me. That's why when a few groups asked me to provide an expected return of gold, and I said, I cannot. I don't have confidence doing so. So some investors, they are good at forecasting commodity prices, so they can extract exotic beta or alpha from investing in commodities, but not average investor. Another confusing